Good evening, everyone. Today, as usual, we are working on a series 21 days, 21 insights. We are running a learning series. So, we are trying to bring a habit of learning every day at least for 10 minutes. So, as usual, today we are at 5 p.m. CST. We are going on live. So today's topic is 1031 exchange. So 1031 exchange, the secrets of 1031 exchange, how investors keep more money. The first one, for every asset, whenever we sell an asset after holding for certain period of time, if you get any gains, it's called capital gains, and we need to pay capital gain taxes. It could be up to 23.8%, which is a long term capital gain tax, or it could be up to 40.8, which could be short term capital gain tax, including 3.8% of net investment taxes. So today I am going to share one of the most powerful secrets used by wealthy real estate investors for last so many decades. And this strategy is legally allowing you to sell a property, defer taxes, and reinvest the entire money into a bigger and better asset. Yes, that is the strategy called 1031 exchange. You are exchanging with a other property. If you are if you have ever wondered to see, many real estate investors don't pay lot of taxes to IRS. One of the reason is depreciations. One of the other reason could be 1031 exchange. Whenever they're selling the property, they find a ways how they can defer the tax liabilities to the future and keep the money what they're earning. So now I would like to today let's get into a bit more details. So what is a 1031 exchange? So 1031 exchange is like a like-kinded exchange that which will let you to sell an investment real estate. This is not applicable for your primary home. When you sell an investment real estate and reinvest the entire proceeds into another investment property without paying any capital gain taxes today, you need to pay taxes in the future because you are deferring your taxes. So they said this is a vehicle which where you can use this vehicle to defer your tax liabilities. This means no capital gains today, no depreciation recapture tax. So a lot of people are very much worried. Whenever they sell the property, they need to pay depreciation recapture. If you go for 1031 exchange, no depreciation recapture today, no federal tax bill today, and the more money you are investing to buy a better or similar real estate property. So instead of paying taxes of up to 23.8% or 40.8%, you are investing and building your equity in some other real estate property. See, this is one of the great, amazing tool all real estate investors use it. Then I will what does it mean? I mean, how do we save money? Yes, when you want to implement 1031 exchange, there are three key rules you need to follow. Rule one, there is a 45 days identification rule. It means once you sell your property, you have 45 days time to identify a new replacement property. Up to three replacement properties you can identify. And it means if you cannot identify the property within 45 days, then this entire exchange formula won't work at all. Then once you identify, then you need to close the property. Only first one is only identification. From the sale of property within 180 days, this is the rule number 2. Within 180 days, you have to close the property also. So the total from the sale to close, from the first selling the first property selling and to close, it's 180 days. And the third and important rule, the same taxpayer rule. What does it mean? Whoever is selling the property, the same person has to buy the property. That means if an individual is selling the property today, the new property also should be on the individual name only. If you are buying the property through an LLC, the new property also should be under the same LLC. So this is a very important formula, very important rule. So there are three rules. Okay, Anil, then what exactly is really do you see a benefit? Answer is yes. I want to give an example now. Example, you bought some property for $300,000. You're selling the property for $600,000. What is the capital gain amount? $300,000. And the $300,000, the difference, you need to pay federal capital gain taxes of 20%, social security taxes, net investment tax 3.8%, and depreciation recapture is at 25%. So you have already claimed some depreciation on this property, that also will be recaptured. On top of that, you might need to pay state taxes also based on which state you are. If you are living a place like me in Texas, Dallas, we don't have state taxes. But altogether, on $300,000 of capital gain, you will be shelling around 70 to 100 thousands of dollars in capital gains, capital gain taxes, and depreciation recapture. So very, very important. The next one, I want to give some examples now, case studies. Let's take some case study of recently what I have seen personally in one of our clients. One of my client who has single family rental in Austin. It's an investment property. He bought it in 2019, I believe, for around $250,000, and now he's selling it for $550,000. He sold for $550,000. So with this capital gain of $300,000, to save this capital gain of 300, the capital gain of $300,000, we recommended them to invest into implement 1031 exchange. So what happened? Immediately this guy started looking for properties, and instead of one property, he found one more similar multi-family unit where there are 4 units are there. One property, but it has 4 units. So what happened now? He closed the 1031 exchange. We were there with him throughout the journey. Now what happened? Because he invested in a better property, bigger property, his cash flows got increased. He has paid 0 taxes. That tax money he's reinvesting to in new property, and because of the new bigger property, he is also going to get higher depreciations also going forward. And of course, real estate has a long-term appreciation advantage also. This is the one case study. And now I want to give one more case study. An investor who has one sick property. It means always there are some challenges, there are some problems, and he has been struggling on the cash flow. The rent whatever is coming, is getting on the property, he is not even enough to take off EMI and repairs and maintenance. So what we recommended, come on, let's go and sell this property and buy a better unit, better property. Then what he has done, he found some better properties. Again, he bought some multi-families property he bought, and he started having a better cash flows, and he came out from the problem, no tax impact. Again, he just reinvested into a similar property, but he has a better life. So a lot of people are very much worried to sell a property because they need to pay capital gain taxes. In overall, lesser tax impact now, increasing your wealth. That is what very, very important. And now I want to talk about some common mistakes to avoid when you implement 1031 exchange. Number 1, not involving a tax expert early. What does it mean? Before you're selling the property, you need to engage and work with your tax advisor, because if you do even one mistake, the entire 1031 exchange will be void. Because when you sell this property, You cannot touch the money into your personal account. You need to have an escrow account. The entire sale proceeds has to be invested in the escrow account. Through that escrow account only, you have to reinvest. With this, what happens? You are deferring. With this, you don't need to pay any taxes on the capital gain. But if you take any money out from this sale proceeds into your personal account by mistake because you don't know how to implement 1031 exchange, then you will struggle. And also, missing the some time for missing these days. Some people will miss 45 days rules. Some people miss 180 days rules. There is nothing you can do after that. And the cherry on the top is the golden strategy for this is keep exchanging until you die. If you followed my conversation, beginning of the session, I said people have been doing this for so many decades. What does it mean? This 1031 exchange is there as per the tax law for a very long time. If you can keep buying new assets, whenever you're selling a new old asset, whenever you're buying again new asset, when you are doing this game, you don't need to pay taxes till the final one when you sell. Unfortunately, if someday something happened to you, and if you are deceased, your next generation gets this asset. The next generation gets the asset at the fair market value because of step up basis formula. And now, when the next generation gets our assets, then they don't need to pay any capital gains on the entire appreciated deferred gain. So, so many years you have been exchanging. If something happened after 20, 30, 40 years, next generation also doesn't need to pay any capital gain taxes on this entire appreciated value because next generation gets the money on the fair market value. And now, what is the action now for you? Whenever if you are a real estate investor, next time whenever you are thinking about selling a property, you might be paying some capital gain taxes. That's why you need to talk to your consultant or CPA, or at least don't stop exploring 1031 exchanges. So 1031 exchange is not only tax saving tool, it's a wealth building tool. It's a wealth building engine. Keep buying the assets. Don't ever sell the properties because you need to pay capital gain taxes. If you have to sell the property, go for 1031 exchange and keep building wealth. That's why you are reinvesting money. Instead of paying to IRS, you are reinvesting into your long-term properties. You are building a wealth, which could be a legacy, generational wealth. Real estates are one of the great way to build wealth. I am not a real estate agent. I am not I'm not selling anything. I am only explaining some tax planning strategies which could help you to save few thousands of dollars year on year basis. The best way to build wealth is to get the knowledge of all these tax planning strategies. It's a very simple. Just follow us every day, 10 minutes at 5 p.m. CPM, 5 p.m. CST. Join and start learning one new topic. Stay tuned for tomorrow's new topic again. Thank you very much. Bye.